Okay, thank you for that, Bruce. Let me explain what we're going to do this morning. We're going to follow four sort of key topic areas as we proceed through this morning. First, we're going to look at the global perspective, something increasingly that we're asked to look at before we cover the Australian and Queensland situation in terms of the economy and the property outlook. Then we're going to drill down into the detail of the various property sectors here in Brisbane before wrapping up. So we're going to start with Ray Torto, who's our global chief economist, who is actually based in Boston. He has over 30 years experience in property economics. He was one of the first people to actually develop econometrics and property forecasting in the US market. Now, of course, he's not with us today, but he actually has recorded a piece for us to explain how he sees the global economy at the moment and how he sees it recovering, and also the implications of that, more particularly probably the focus of global concern these days. So let's move now to the DVD and hear Ray Torto.
Good morning in Brisbane, Australia. Thank you for inviting me to your breakfast. My name is Raymond Torto, Global Chief Economist for CB Richard Ellis. Kevin asked me to speak to you briefly this morning a little bit about what's going on in the global economy and the global real estate markets, with a particular emphasis on the United States. I was fortunate enough, in fact, a year ago to be at your forecast breakfast in Sydney. I enjoyed it very much, and I wish I could be with you right now. When I do think about the global economy, I like to describe it, because it's quick and easy, in terms of the letters of the alphabet. And I think you've all heard this description before. You can think of the economies that have all had a synchronized downturn, and now all in very different stages of recovery. And one way to describe those recoveries is a L-shaped recovery, a V-shaped recovery, a U-shaped recovery. Or maybe if you put it in LUV, we can call it a love world. The world can be divided briefly like that, and a little bit simple, but nevertheless it does work. There are those economies, for example, where they are currently in an L-shaped recovery. It looks like they're bouncing along the bottom, and they're going to continue to do so for a significant period of time. Economies that come to mind right away, of course, are places like Greece, a little bit of Japan, Spain, Ireland. Then there are those economies that are much more V-shaped, and clearly Australia is in that category. I would argue that you barely were touched by the Great Global Recession. And you were so well prepared for it, and lucky, I would say, because so much of your commodities are demanded by other parts of your region that are growing quite significantly. But along with Australia, there are others, clearly China and India and Singapore. But also you can move to other regions of the world and see places like Brazil, Latin America, Panama, Canada. These are all economies that are definitely in V-shape, are all doing very well, and are prospects for your investments in real estate. But what Kevin really wanted me to speak a little bit about this morning was what's going on in the United States. And that's an economy that I would definitely say is in a U-shape. And we're off the bottom of the U, but we got a long ways to go before we get back to what I would call the level of jobs or prices or capital values that we saw back in 2007. One way to think about it in the United States and what is going on, in my view, is that the public is very impatient at this moment, and that impatience is being reflected in what we read in the media and in what we see in the political discourse. And they're impatient because it's been 2 years, and this recovery is much longer than any other recoveries that we've faced. But the way you have to kind of think about it, what's going on in the United States, is we were the epicenter of this downturn. We were badly hurt. We went into a trauma. We were for almost a year in intensive care. And as we look at where we are today, we're in the rehab section of the hospital, but we are still in the hospital. So the doctors are telling us we're getting better, but we are not healthy yet. So the question that a lot of people are debating, and as they look at the economy, is whether or not we might go to a double dip. I don't see that as a prospect. I do see, however, a very long time period before we get better. But again, there are some positive economic signs. As GDP is growing, final purchases by consumers are rising, exports are up, imports are up, retail sales are reported today to be doing quite well. But again, it's not at the levels that we saw back a couple years ago. So it's the slow process, it's the time it's taking that is affecting a lot of the discourse. One statistic to throw at you and kind of think about what's going on. When we talk about real estate, we always talk in terms of the economy, in particular jobs. And in the United States, there was approximately 138 million jobs in 2007. Today, there's roughly 130 million jobs. And in the United States, there was approximately 138 million jobs in 2007. Today, there's roughly 130 million jobs. For the economy to get back to its previous health, we need to grow back those 8 million jobs. And that's going to take another 3 to 4 years before we get back there at the current pace that we are growing. And some would say maybe it's even going to take longer. So that's the economic situation. It's not that it's not getting better. It's just that it's still in rehab, and it's going to take a long, long time. And I would say there's a lot of impatience. Now, that's the economy. If we switch and kind of look at what's happening in the real estate market, it's very interesting that real estate fundamentals in the United States have actually turned the corner in the second quarter of 2010. Office vacancy rates fell by 10 basis points. For the first time in 7 quarters, we've actually seen a decline in vacancy rates. Industrial vacancy rates also fell by 10 basis points. Multi-housing vacancy rates have dropped by 30 basis points. So that we're really starting to see a turn in the overall fundamentals. Now, again, it's as I just returned from a meeting that we had at the Urban Land Institute in Washington, D.C. The discussion around the table was that we're off the bottom. Things are stabilizing. But again, there's a question of how long it's going to take till we get back to the vacancy levels that we saw in the middle part of the 2000s, or vacancy levels that would allow us to start to move rents up. And what we're seeing in the work that we do is that rents in the United States will probably be very flat across all property types in 2011. And it won't be until 2012 that we'll start to see rent increases in the neighborhood of 4 to 5% across every property type but retail. Now, to put that into perspective, rents in the office sector, for example, have dropped about 30%. So they've gone from $1 to 70 cents. To get a 4% increase on that 70 cents doesn't get you back to $1. And it's still going to take you a while before you're going to get back there.